That's where we were, or where we came from. We talk about where we are. Wondering how long this bull market can last. Because it just keeps going and going and going. Energizer Bunny style. Okay. So Robert Shiller's CAPE ratio. You're familiar with that? We do this often. 10-year current price, 10-year earnings. Okay? And we see Black Tuesday, Black Monday, 2000, 32.64 is current. So I want to do a little thought experiment. So if it's 10 years of earnings, and that's what we're looking at, is 10 years of earnings. Look at the price over 10 years of earnings. How does that 32.4 come down? Well, there's 3 ways it can come down. What are the 3 ways? It's price, earnings. What are the 2 most obvious ways?
Price goes down. Earnings go up.
Right, price goes down, earnings go up. But this is an equation, this is a calculation. We're looking at 10 years of earnings. What happens next year?
Earnings go up. Earnings go up.
And so you're moving forward a year. What year do we lose?
So low in 2009.
It was non-existent in 2008. That's what drops off. So next year, end of this year, we lose, or we gain actually, a full year of earnings, and we lose a year that didn't have any earnings. So what's that, 10% of earnings? Just, I don't know, ballparking it. So this 32 goes to 28 like that, without any change in the ratio. Just move forward a year, okay? So what else happens next year? So earnings increase this year, 2017, was about 16%, ridiculous. Let's say it tampers down to 10, which is probably, it's likely to be higher because of the tax changes. But let's just say it's 10%. It's 10%. So we lose a year that's bad. It comes down, it goes from 32 down to 28. Earnings go up 10%. What do we have? 25-ish, give or take 1 or 2, right? So these valuation numbers, you got to take them with a grain of salt. And everyone's going to use it and just look at this and say, look how high that is. That's very, very bad. But next year, that rolls off. Does that mean it won't crash? No, it doesn't mean it won't crash. It just means it's not a reason, and this is what Savita Subramanian at B of A Merrill Lynch says. It turns out that valuations are a really lousy market timing tool. Doesn't work. There is no correlation between valuation and a market collapse. Yes?
What impact do you think the 2018 elections will have?
I have no idea. It depends which way it goes. I mean, no idea. Did everyone get the question? What impact will 2018 election have on markets? In the short term, there'll be an impact. In the long term, it won't matter. Right? Okay. So this is really important. And this is why we put this in the beginning of the letter in January. It is normal. It is beyond normal that every year there's a decline in markets. So if you look back till 1945, the average annual intra-year market decline is 14%. Since 2009, we've had multiple 13 corrections. They've lasted 60 days on the way down, 55 days on the way up, average decline of 9.1%. There were 2. In 2011, there was a 19.5. 2016, remember the worst January in history? About a 15% decline. So 2 that were not big, but sizable, right? But that's it. That's all we've had. You know, we've had these little things, 8%, 9%. Yesterday we had 1.25%. Whoa! Did anyone panic? Do you notice headlines? It's crazy where they go with these things. So we're down to, so January, one sec. In January of this year, we're up 5-6% in January, even though we had that 1.25% decline yesterday. Okay. So we looked at that investor sentiment. We looked at investor sentiment a moment ago, very bullish, low on the bearish, right? So this guy is from Goldman Sachs. He's basically saying that if he saw a sell-off of 15%, he would think that it's probably due to a change in sentiment, a change of how people feel about it, not necessarily a change of anything structural. Okay, wage pressure, okay? So unemployment, this is actual unemployment in advanced economies. It goes from 9 down to 6. It's kind of a long-term average space it's at right now. In the US, it's down to 4.1, right? It hit 3 point something. By the end of this year, it'll probably be 3.5, which is because we're adding jobs. Okay, there's a problem here, and there's a problem with growth. The problem is, if I want to hire somebody new, I have to pay up, right? Because I've got to hire them from someone else. And if they want to keep that employee, they have to pay up because that person is looking for another job. That's where wage pressure comes from. And we haven't been there. We've just now gotten down to, the bottom of unemployment. So wages have gone up. They have gone up more than inflation. So there is real earnings increases that have existed for the 2 or 3 years. Those are going to get even tighter, bigger in the next couple of years, 3 years. And then that's going to create a problem. And the problem is wage pressures. If I have to hire, so I have a profit margin. I'm a businessman. I have a profit margin. I like my profit margin. All business people like their profit margin. That's what they like. So if I have to pay more for materials, if I have to pay more for people, build a new plant, I want my profit margin. So what am I going to do? I have to raise my prices. If the market lets me raise my prices, that's a big question. We don't know what's going to happen. If it's a better good, if I can add a value-added service on top of it, maybe I can raise my prices. So this is the beginning of inflation. And that's what we're seeing over here, core inflation. The expectation is that global core inflation is picking up. We've seen this chart before. We've seen the expectation happen before. It looks like it's real. We don't know how big it gets. We don't know how long it lasts. Yes?
What difference is there between structural and actual unemployment?
Yeah, so structural unemployment results from a change in the structure of an economy. Like we do less industrial stuff and we add services. So that might cause employment to go down structurally. Okay, so inflation happens. We're sort of expecting a pickup in inflation. So what does that do to stock prices? The average, just looking at, these are the different CPI, different inflation numbers. You look at it between 0 and 2, that's where you get the highest PE ratio. So stocks like earnings going up in a low inflation environment. That kind of makes sense, right? It should kind of make sense. As inflation gets bigger and bigger and bigger, it takes larger hurdles of earnings for that to actually go to the bottom line in a real way. Okay? So we're still here though. We're still in that 0 to 2 range. So one of the reasons you see PE ratios, valuations the way they are, is because we're in a Goldilocks inflation space. Very busy, another one of these busy charts. This is the 10-year bond yields for lots of different countries. Note, this is the US. So we pay a lot more for our 10-year than anyone else does. And we're raising ours, and they aren't yet. So what should that do? That should strengthen, what we should see is a stronger dollar. We're not seeing that though. Why? I can't tell you. It's one of these things that it's an interesting anomaly. Michael, you look like you have a thought. No thought. I thought you were going to answer my question because I would like to know. Okay. So tax reform. So this is going to actually have about a $1.5 trillion benefit to the economy. It's a fiscal stimulus. Don't get it wrong. It is a stimulus. It's going to be selective on the stimulus. It's going to hurt a lot of people on the coasts who are going to lose our state and local income tax deduction. No question. It's going to be painful for us. It's going to be a benefit to companies, and that's what we talked about. Earnings on the S&P, I think, go from 141 to 151 just based on tax changes. Okay, that's a big deal. Yes?
What about what it's doing to the deficit?
Thank you. That's beautiful. So we have, this is the Booth School of Business in Chicago. Did a survey of economists. These are educated economists. This isn't a public survey. And they asked the question, will the US GDP be substantially higher a decade from now? Looks like the economist says no. The general average economist says, maybe, I don't think so. Will the US debt to GDP ratio be substantially higher than it is a decade from now? I don't think there's any doubt what the economists think, right? So how many times do the economists write about these things? It's pretty rare, Like, they get it wrong all the time. Are they any smarter than we are? Yeah, they're probably smarter than we are in terms of analyzing stuff. It doesn't mean they know what outcomes are going to be. I think they're wrong here. We have a $20 trillion economy. If we grow at 2.5%, that's $500 billion. In 10 years, with some compounding in there, it's, what's that, $6 or $7 billion more? $6 or $7 trillion, I missed 3 zeros. $6 or $7 trillion bigger. We go from 20 to 26, 27 trillion. That's an enormous jump. So I think that's a little short-sighted, I think. This, no doubt about it, we're going to have a much bigger deficit. Or, probably even worse, we stop spending on something. Pick it. Well, given the current scenario, it's going to be human services, right? Yeah, whatever. So if we don't have a higher deficit, it will be because we've hurt people. That's the choice.
That's not speculative. That's what's.
No, that's a fact. Yeah, that's going to happen. Yeah.
But we'll have a wall.
We will have a wall.
I knew it was going to be this way today. So this is what we just said, right? It goes from 151 from 141, just based on the tax changes. So let's talk about where we are in a market cycle. Okay, the U.S. is this light-ish blue one right here. Now, this is a neat little thing here, right? But look at this. I think we're mid to late cycle. If you use a baseball analogy, it's 7th inning. There's some of this is true, some of this is true. But the interesting thing is, and this is why that international opportunity exists, right? These folks are still behind us. They're still ramping up. They're still mid-cycle, early to mid-cycle. So that's why we're shifting assets and have been shifting assets from the U.S. to emerging markets and international spaces. There's still upside. The value has not been recognized. And they're still growing earnings. They're still stimulating their economies. Okay? And they need to. It's not like we're doing it when we don't need to. They need to do it, and they're doing it, and they're going to come out of that. It's going to be a positive for them. What is this? Another really busy slide. It just looks at sector versus cycle stage. To say that there's, oh my God, there's a recession, there's no opportunity, it's not grasping what opportunity there is. So I am not a sector rotation person. I own all of it, all the time. And we rebalance, right? It's the only way that works over time. It's also idiot-proof. I can't screw that up, okay? So in the early cycle, like we like consumer discretionaries, we don't like energy, right? But we have them both. They kind of even out. In the late cycle, we don't like consumer discretionary. We love energy. We own them both. They kind of even out.